Dear investors and friends, welcome to our monthly video on markets and investing. So this month we will talk about a few things. First, we will talk about the trends in the Q1 earnings, which the season has just gone by. We'll look at not only the aggregate earnings picture, but we will also look at how various sectors have performed during Q1 and try and discern a few trends from there. And then we will talk about the capex trends in Q1. So let's start with earnings first, right? The Q1 earnings, which is from April to June, are now out. And after 5 quarters of back-to-back solid double-digit growth, this quarter definitely has been much more subdued than the trend that we've seen over the last several quarters. And if you look at the top 500 companies, as well as the Nifty companies, the top line growth has been 6.6%, exactly the same for 500 as well as for the 50 companies. And the bottom line growth has been 4% for the top 500 companies and 5% for the Nifty 50. So essentially, after a solid double-digit growth this quarter, both on the top line as well as on the bottom line, it's been a very subdued single-digit growth. Now, what explains this slow growth compared to the previous quarters, right? This quarter was an election quarter. And as you know that typically an election quarter is slow because the whole country and the government, everybody is pretty busy with the campaigns and elections. Consumers generally tend to put off large spending decisions. Government departments and ministries cannot give out orders or cannot spend money because there is the election code of conduct. And also, we had a pretty harsh summer this year. And therefore, we've seen that during the conference calls of several companies in Q1, they did bring up these two reasons why they've seen a relative slowdown in economic activity, which is that we had very hot summer days this summer season and we had elections. And therefore, that is one of the context. The other context is also that last year in Q1, we had a very stupendous improvement in margins because, as you know, we had seen a significant recovery in EBITDA margins in Q1 of last year, and therefore the base is much higher. It makes it that much more difficult to outperform on a base which is very, very high. So we believe that, as you know, what we said last quarter is that from here onwards, it's really the top line growth which will drive earnings growth. And because revenue growth has been in single digits and we didn't have the tailwind of incremental margin growth because of the high base last year, we've also had bottom line growth which has been in single digits. However, as you will see, we do believe that the second half of the year should be much better and growth should come back to double digits. Coming to the sector-wise performance, while the aggregates were in single digits, there were sectors which did phenomenally well and there were sectors which were significant laggards when it comes to Q1. And if you look at the numbers, the top 5-6 sectors which have really outshined are telecom services. As you all know, that after a very long period of time, there was a hike in telecom tariffs, and therefore we've seen that telecom services has delivered a far stronger growth, or losses in the case of Idea, Vodafone Idea has reduced dramatically, and therefore that sector tops the charts. Secondly, consumer durables, where earnings almost doubled, 100% plus PAT growth Q1 to Q1. And that's largely because a lot of the EMS companies, or electronic manufacturing services, delivered stupendous growth. And you also had a few consumer durables companies like air conditioner companies, which did phenomenally well because of a very, very hot summer. And therefore, consumer durables did phenomenally well. Healthcare was up with a 80% growth, infrastructure with 50% growth, capital goods with 30% growth, and auto ancillaries with 26% growth. So these were the top 5-6 sectors which delivered stupendous growth YOY. Which were the laggards? Well, energy was minus 42%, and that has largely to do with the fact that the oil marketing companies had a much lower growth this quarter. Building materials minus 26, agrochemicals minus 26, cement minus 14, and chemicals minus 10. So these were the bottom sectors, and therefore on a broadly aggregated basis, we've not seen a significant growth. I must though mention here that financials stood out this quarter when you look at the overall aggregate averages. Banks have grown at about 17-18%. And you would wonder that despite doing so well, broadly speaking, the banks haven't done that well when it comes to stock price performance. And we've spoken about this earlier, that we believe that there are headwinds in terms of credit growth, and an even greater headwinds when it comes to deposit growth. And therefore, the entire sector is currently dealing with these headwinds. And despite a mid double digit growth in earnings, the stock performance has been less than spectacular. And we believe that these challenges will continue until you have a very serious reduction in interest rates. So having deconstructed the sectoral performance, we also wanted to give you a context that the subdued Q1 performance to us seems like more seasonal in nature, and we do believe that we should see a significant recovery in earnings from Q2 and especially from Q3 and Q4 onwards for several reasons. One, as I said, we had an election season in Q1, that's not going to happen anymore. Secondly, we've seen very good rainfall, and therefore monsoon should also help demand. We will also enter into the festive season and the marriage season, so therefore we should see some pickup in demand. And as the government now gets down to business, we should also see capital spending also perking up. And therefore, I wanted to give you a perspective that one should not extrapolate the softness in Q1, right? The reason why we want to give you this perspective is because, as you all know, that we are continue to be bullish on capital goods, infrastructure, manufacturing, cyclicals. That's exactly where our current portfolios are positioned. And therefore, we culled out some data to give you that perspective, right? Now, as you know, that the government has provided 11,11,111 crores as the capex budget for 24-25. Now, usually, if you look at the trend of the previous 2 years, that is the financial year 23 and financial year 24, usually in the first quarter of the year, the government ends up spending somewhere between a quarter to a third of the full year's budget in Q1 itself, right? So in FY23, the full year capex was 7,40,000 crores. However, in Q1, the government spent about 1,78,000 crores, which represented 24% of the full year capex in Q1. In the last year, that is FY24, the full year capex was 9,48,000 crores and the government ended up spending 2,78,000 crores, which roughly represented 29% of the full year budget. However, this year, of the 11 lakh crores that was budgeted for capex for this year, the government has only been able to spend 1,81,000 crores, which is just 16% of the full year budget. And as I told you, the reason why we've seen a very low spending on capex is because of elections, right, and the model code of conduct. But however, the good news is that assuming that the government wants to spend all of this 11 lakh crores during this financial year, then you will see an accelerated spending from Q2, Q3 and Q4, which means that the next 3 quarters will have to make up for the slack in spending that we've seen in Q1. And that is the reason why we believe that the subsequent quarters should see a significant pickup in economic activity, and as the ordering and government spending improves dramatically, we will be able to see that momentum in the top line and bottom line, especially of the domestic capital goods, manufacturing, defense, infrastructure, railways and those kind of sectors which depend on the money spending by the government. To give you a greater insight into this, what we did was we looked at the spending of each of the important ministries and we looked at the top 10 ministries which spend money, and we looked at the data for last year Q1 and this year Q1. And if you really look at it, the number one spender is the Ministry of Road, Transport and Highways. Last year in Q1, they spent 99,000 crores, almost let's say a 1 lakh crores. This year it's been only 60,000 crores, it's 40% lower. And the minister is the same, which is Shri Nitin Gadkari. So obviously there is no change in the ministry there. We just believe that we should be able to see accelerated spending as we go along. Secondly, if you look at the Ministry of Railways, again here the minister is the same, Shri Ashwini Vaishnav. Last year we spent 78,000 crores. This year it's been only 66,000 crores, which is 15% lower. Third highest is the Ministry of Finance. Last year they disbursed 30,000 crores, which is the transfer to the states, right? So every year the Ministry of Finance transfers the money to states for spending. Last year in the Q1 they had already disbursed 30,000 crores. This year it is 19,000 crores. Again, as you all know, that the finance minister is the same, which is Srimati Nirmala Sitharaman. So that should also happen. That's 37% below Q1 of last year. The fourth is Ministry of Communication, the previous minister was Ashwini Vaishnav, now it is Jyotiraditya Scindia, and there we've seen almost no spending. So as against a 27,000 crore spending in Q1 of last year, this quarter we've only seen 546 crores. So there is a lot of pickup that should happen logically in the subsequent quarters. Ministry of Defense, 19,000 crores last year, 14,000 crores this year, down by 25%. Again, as you know, Rajnath Singh continues to remain the defense minister, so there is continuity there. Ministry of Consumer Affairs, Food and Public Distribution, it was Piyush Goyal. Now it is Prahlad Joshi. There again, this is typically deals with subsidies on food and MSP payouts, etc., which this last quarter was 10,000 crores and this quarter is still 5,500 crores, so it's 45% down. And similarly, if you look at the trend of all the ministries, right, I mean, you will see that clearly in Q1, the ministries have not been able to spend because of the election, but we believe that going forward, we should see a significant pickup in spending. And lastly, we looked at the data that a lot of the capital goods companies give out in terms of both order intake as well as their cumulative order book. And that tells you the momentum, at least in many of these capital investment cycle oriented industries, right? So we have data for, we've culled out data for several companies in the capital goods space, except for L&T and BHEL, who typically have not given out that data on a quarterly basis. And therefore, X these two, you will see that the order inflows on Q1 of FY25 is up approximately 20% YOY compared to Q1 of last year. So even though generally activity in Q1 in this sector is much lower, but if you compare the order inflow in Q1 of this year with the order inflow Q1 last year, then the order inflow this year is higher. And if you look at the second table on the right, you will see that the cumulative order book position in Q1 is at its highest. It is still running at a run rate of 20% YOY. So that gives us the confidence that the revenues and the execution will pick up in the subsequent quarters, and the lead indicators for these companies, which is that order inflow in this quarter as well as the cumulative order book, continues to be relatively strong. So with this, we'd like to end our this month's video. We will continue to track a lot of this macro level data and data which gives us the confidence to monitor the progress of the growth in the economy and the performance of the underlying companies in general, and specifically the ones that we have in our portfolio. So in summary, a tepid Q1, however, it's something which, as I mentioned, was largely related to seasonal factors and elections. We do believe that the momentum in the economy and in the revenues and profits of companies should pick up in the subsequent quarters, and we will report to you month after month and review the progress of our underlying portfolio companies. So thank you once again. Until next time.